Wow, so this is probably one of the most requested videos that I've been asked to make, and the day has finally come, because in this video I'll be taking you from beginning to end and showing you exactly how to invest in the stock market step by step, with an emphasis on how you can build a high growth portfolio. And so I'll be sharing all the knowledge, strategies, as well as my own investing philosophy that has enabled me to aggressively grow my capital and go from being completely broke, earning $7.25 an hour as a cashier, to now having a stock portfolio worth well over $2 million, and doing all of this before turning 30 years old. So whether you're a beginner in the stock market who has never bought a stock before, or even if you're somebody who has already been investing for a couple of years now, I promise you that you will get a tremendous amount of value from this, because you're going to learn exactly how I identify great companies to invest in before they experience massive growth, things to look for, and what to avoid, as well as a ton of other golden nuggets spread out all throughout this video. Because what I'm going to share with you today is the culmination of what took me over a decade to learn, all condensed and simplified into one ultimate video for you guys. So I'll be holding absolutely nothing back. So I highly recommend that you watch this from beginning to end. And if you appreciate the amount of effort that went into making this, all I ask is that you subscribe to the channel and drop a like if you find value in this video. But with that being said, let's not waste any more time and let's get right into it. So first, who am I and why should you even listen to me? Well, I used to work at Ernst & Young, which is one of the biggest 4 accounting firms in the world. But since then I've started several businesses, traveled to multiple countries, and I've been investing in the stock market now for over 10 years, where I've been able to grow my portfolio to having well over $2 million in stocks by the age of just 29. And I say that not to brag, but just to show you what's possible if you start taking investing seriously, and especially if you do it the right way. And I also want to make clear that you don't need to have a business or make a lot of money to get started investing, because that certainly wasn't the case for me. In fact, when I first started investing, I only had $500 to my name. Not $5,000, not $1,000, just $500, which to me was a lot of money back then, because I didn't come from a wealthy family. You see, I am the youngest son of 3, and my parents are both immigrants who came to the US with nothing but the clothes on their back. They are extremely hardworking people, but they never got an opportunity to attend school when they were younger, so the only way they knew how to make money was through hard physical labor. My mom cleaned dirty hotel rooms as a maid for over 30 years, and my dad was a busboy at a restaurant, wiping tables and filling glasses. And I tell you all of this because I am sure that many of you can relate to my story. My parents never made much money, but worst of all, nobody ever taught them how to make their money work for them or how to invest, which is one of the reasons why I am so passionate about what I do. But also, I knew from a very young age, especially watching my parents work endlessly and sacrifice pretty much everything just to be able to provide a better life for my siblings and me, that I damn sure wasn't going to let their efforts go to waste. And so today I want to give you guys the building blocks and share my knowledge with you so that you can also feel confident and empowered about investing in the stock market, and with that, become that much closer to financial freedom. Now, we have a lot to discuss in this video and a wide range of topics to cover, such as why it's so important to invest your money in the first place, and how can you consistently find winning stocks with 10 to 100x potential. Plus, we'll be debunking a multitude of common misconceptions that most people have, such as explaining why a stock's price doesn't actually matter, and I'll even be sharing some game-changing investing advice that my accountant told me several years ago that could literally save you tens if not hundreds of thousands of dollars in taxes. But first, let's go over why savers will always be losers, and it all boils down to just one thing, and that is that every day that you choose not to invest your money, you are losing money to inflation, especially with interest rates at all-time lows. And real quick, for those that might not know what inflation is, it essentially means that what you can buy with $100 today is a lot less than what you could have bought with $100 20 years ago, because the value of the dollar in the US is decreasing between 2 to 3% every year, which may not sound like a lot at first, but actually what it means is that every 20 years, your money will be worth half of what it's worth today. So if you're one of those people who find yourself stashing the majority of your cash and leaving it in your bank account doing absolutely nothing years upon years, then you are basically throwing half of your hard-earned money away. Now don't get me wrong, this was exactly what I was doing for more years than I care to admit. And this all comes down to your mindset. Especially when you grow up with limited resources, it's very easy to find yourself trapped in a scarcity mindset where you believe that money is hard to get. So any little bit of money that you can possibly get your hands on, you hold on to it for dear life. Cause the reality is, you feel like you don't know when you'll get more money or when you'll need it. But now here's the good news. Having a scarcity mindset is just that. It's just a mindset that is self-imposed. And just like we change our minds all the time on simple things, like what we want to eat today, you can just as easily choose to change your mindset on the way you look at money and move it from being in a place of fear to a place of confidence. And a huge part of building that confidence in yourself is by investing your time into things like self-education, just like you're doing right now. Because the more you educate yourself on how finances and money works, the more confident you'll become in your own abilities, and the easier it'll be for you to switch from a scarcity mindset to one of abundance. And when you start to think differently, you also start to see things differently, and then you start to do things differently. And all it takes is just a conscious effort from your part, not to be willing to settle for anything less than you deserve, and to want more out of life. So now that you know why it's so important that we make our money work for us, let's quickly go over some of the basics, like what even is a stock? So the easiest way to think about stock is it's basically a share of ownership in a company. So for example, even if you just buy one share of Tesla stock, you are now officially a partial owner of Tesla the company, which is pretty badass when you think about it. Albeit you have a very small ownership stake in the company if you just buy one share, but still a stake nonetheless. Also, every publicly traded company has a specific amount of total shares, and you can think of each share as being a slice of pizza. So when you buy a share, you are buying a slice of ownership, which is also commonly referred to as having equity in that company. And when you hear people talking about a stock's market cap, that is simply the market value of the entire company as a whole, or in simpler terms, it's the amount of money that the market believes that that company is worth today. So if we take Tesla stock for example, which is currently trading at about $852 a share and has a market cap of $807 billion. Now the way that number was calculated is by simply taking the total number of shares outstanding, which for Tesla is around 948 million shares, and then multiplying that number by the current share price. Now obviously you don't have to manually calculate that number every time, since a quick Google search will provide it for us, but it is extremely important that you at least understand where these numbers are coming from. But why do companies even issue stock in the first place? Shouldn't they want to keep complete ownership of their company? Of course. But here's the thing, companies like Tesla have massive aspirations to expand quickly, and in Tesla's case in particular, they want to accelerate the world's transition to sustainable energy. And let's just say accomplishing that mission is definitely not cheap and requires a ton of money, otherwise known as capital. So in summary, companies issue stock simply as a way to raise money in order to fund various initiatives like accelerating their growth, being able to expand internationally, or simply to fund new products, or even to do more research and development. And just like how you can go on eBay and buy and sell products, the stock market is essentially very similar in that it's just a fancy marketplace where you can buy and sell shares of real publicly traded companies. And once you truly understand that, then it's a whole lot easier to understand why stock prices can go up or down on any given day. Now of course there can be a multitude of factors that contribute to the change in a stock's price, such as the company reporting earnings or unveiling a new product, or maybe there's some huge industry news or a big new competitor that has entered the market has gotten investors worried. Or in the case of Tesla, Elon Musk, who is their CEO, posting just one tweet can be enough to send the stock soaring or plummeting within minutes. But let's just say he's built differently. But despite all of these potential factors and complexities, what too many people don't realize is that whenever any stock's price goes up drastically, all it really means at a high level is that during that day, there were more buyers than there were sellers. Because remember, the stock market is just a marketplace, and like any other marketplace, it follows the law of supply and demand. So if many people want to buy a specific stock, but not enough people want to sell that stock because they believe it's worth more and so they don't want to sell at the current prices, What ends up happening is that the buyers will continue outbidding each other and thus raising the prices that they'd be willing to pay for that stock until more sellers finally decide, you know what, I'm willing to sell you my stock at that higher price. And it works exactly the same way the other way around. If there's more sellers than buyers, then the stock's price will go down. But let's just say for the past several months, there has been a lot more buyers than sellers on most days. Because as we all already know, stocks only go up, baby. And we actually touched on one of the main reasons for this earlier in the video. You see, people don't want to lose their money to inflation. And since the majority of banks are practically paying 0% interest right now, most people simply have no other option than to invest their money into the stock market. Thus, there's a lot more buyers than sellers on most days. And this is unlikely to change anytime soon, considering that the Federal Reserve has already stated on multiple occasions that interest rates will not be rising until at least 2023, and possibly even longer. Which is absolutely incredible news for the stock market. And so now that we've established a strong foundation of the basics, let's start getting into some of the really good stuff. Like, how is it even possible to consistently find winning stocks that have the potential to 5, 10, or possibly even 100x over the next decade? How can we identify these special companies early on when there are literally thousands of other publicly traded companies that we could invest in? And the truth is that it's honestly a lot easier and simpler to do than most people think. Now, throughout the years that I've been investing, I started implementing a super simple 3-step system to find category disrupting companies that can 10 to 100x within the next decade. And literally anyone can implement this system and succeed. And let's just say it has worked extremely well for me, to say the very least. And it is the same system that has enabled me to make the right investments at the right time, which has led me to making absolutely life-changing kind of money simply from investing in the stock market. And so today, for the first time ever, I'm going to be sharing that very same system with you guys. And when I say it's simple, I truly mean it. So let's get started. So the first step is as simple as just becoming aware of your surroundings. Now, at first, this may sound silly to some of you, but honestly, just think about how easy it is to get so caught up in our busy day-to-day lives, especially nowadays with our phones always within arm's reach, that we stop noticing and truly paying attention to all the beautiful things and life that's happening all around us. And how do you expect to find the next Netflix or the next Tesla when you're so caught up in your own head that although your eyes are wide open, your mind is completely closed off from what's happening all around you in the real world? The solution? Live in the moment, be present, and never let your childlike sense of curiosity die. And the reason why doing this is so crucial when it comes to investing in stocks is because if you want to be able to spot innovation, technology, and where the trends are heading early on, then you actually have to look up from your phone every once in a while. And I'll give you a perfect example from my own life. So one of my best investments of all time, besides Tesla, was investing into a little company that you might have heard of before, called Amazon. Now, I invested into Amazon well over 8 years ago, and for the simple reason that it was becoming extremely clear and blatantly obvious to me that online shopping was the future and that Amazon was revolutionizing the entire customer experience by expanding their 2-day shipping program across more and more products, combined with offering an unrivaled customer service experience and just making the entire process as convenient as possible. And mind you, online shopping back then was nowhere near as prevalent nor as deeply integrated into our daily lives as it is today. So there were millions of people, including many analysts, who thought that companies like Amazon were absolutely ridiculous and would of course fail because they thought that nobody in their right mind would want to buy products without being able to actually feel or see them with their own 2 eyes. And for me, one of the main reasons that I was able to build up my conviction so early on was because I was able to spot what was happening, which was that Amazon was doing something that literally no other company was doing, which was that they were saving people's most precious asset, their time, because they were shipping products so fast that it started to almost make no sense whatsoever to drive all the way to the store hoping that they have what you need, to then have to wait in line, and then to have to drive all the way back home. Plus, I started hearing people on my way to work talking about how incredible their experience with Amazon was. Not to mention that I was seeing more and more delivery men carrying Amazon branded boxes all around NYC. So the trend was becoming crystal clear right in front of my eyes. So just remember, you don't need a fancy accounting degree or need to know people in high places in order to get in early on some of the best investment opportunities out there. You just have to keep your eyes open and you'll be surprised at the amount of gems you'll find, because honestly, the best investments are usually in companies that you can actually understand. And way too often, I see people trying to invest in stocks that they can barely even pronounce the name of the company, which is just crazy. But now let's dive even deeper, which brings us to step number 2. Because after you identify a potential company that you want to invest in, it's all about building our conviction levels high enough to where we feel comfortable and confident about investing our hard-earned money into this company. And we go about building our conviction by first making sure that their products or services are actually good, because a company won't last very long if their products or services suck, no matter how good their marketing is. Now ideally, if possible, it's best to get some first-hand experience with their products. But obviously, that's not always possible to do with all companies. So in those cases, you would want to search online and see what their customers are actually saying. Are they happy? Do they love the product or service? And what was their overall experience? Like with Tesla, when I was doing my initial research to figure out if this was a company that I even wanted to invest in, before even driving a Tesla myself, it became extremely clear to me that their customers were fanatical and absolutely adored their cars. And after you know that the product is actually good, you need to find out who is their CEO and get to know them inside out. And I cannot stress enough just how crucial this step is, because without the right leader and vision, a company will get absolutely nowhere, no matter how great their products are. So it's all about getting inside their head, finding out who they are, what they're all about, and more importantly, do they seem like the right person who can lead this ship all the way to the promised land? And thanks to the internet, this step is extremely easy to do, because anything you could ever want to find out about anybody is just a Google search away. So I watched dozens of Elon's interviews and even read Ashley Vance's biography on Elon Musk in order to get to know him on a deeper level and to get a better understanding of his vision for where he was going to take Tesla. And after just a few days, I immediately knew that he was the right person for the job. And since I already knew that their products were incredible, then the third and final step is really just all about supplementing our initial research by doing things like looking into their financials, reading their annual report, as well as reading articles written about the company, and even watching YouTube videos from credible creators that you trust can be extremely helpful. Also, we'll be going over more of the technical aspects, like exactly how to understand a company's financials and what to look for a bit later in this video. And don't worry, I'll be explaining it in a way that'll be extremely easy for you to understand and implement right away. But overall, that's it. Those are the 3 simple steps that anyone can follow to identify and invest into the type of companies that can change your life forever. And the reason it's so important to follow these steps, instead of just blindly throwing your money into the first company that your favorite YouTuber recommends, is so that you can remain calm and know exactly what to do during any market fluctuations. For example, even if I were to tell you right now about an absolutely revolutionary company that I know for a fact will succeed over the long term, if you don't do your own research to build up your conviction levels, the minute that that company dips even 10 or 20%, your emotions will get the best of you every single time, and you will panic and likely sell out of your position at a loss. Versus someone like me, who actually took the time to do the research, so that when Tesla stock dropped by more than 50% last year, I wasn't panicking at all, and instead I was literally jumping up and down in excitement, because I knew that this was a golden opportunity that I would likely never see again. And so without any hesitation, I absolutely loaded up on more Tesla stock. And that's the level of confidence that comes with building that conviction that will enable you to make the right decisions and take advantage of opportunities when everyone else is running scared. Also, real quick, before we get into some of the most value-packed sections of this video, I have a massive update for you guys, because just 2 months ago, we officially embarked on a new challenge known as the 10K to 100K challenge. And in just a few weeks, we are already up well over $3,000 on our positions. Now, for those of you who may have missed the announcement, I just recently started a brand new portfolio and funded it with $10,000. And no, we're not talking about some bull paper trading account. This is a real, brand new portfolio that was specifically created for this challenge, and where I'll be showing the exact steps that I would take if I had to start all over again from scratch, and with the goal to aggressively grow my capital as fast as possible to over $100,000 while only taking very calculated risk. So I am beyond excited for this challenge, and we'll even be mixing in some options trading with this as well. And all of this is available over on our Patreon, so if you're interested in joining the family and following us along this journey, this is your opportunity, because signups will only be open for the next few days, and then they will be completely closed for the rest of the month. And just to recap, membership not only helps support the channel, but also includes exclusive benefits like access to our private Discord channel, exclusive content, plus you'll also have 24/7 access to my entire $2 million stock portfolio. And on top of that, you'll also get access to my buy or sell signals, meaning you'll know every single stock I decide to buy right when I buy it, and you'll know exactly when I decide to sell my position. Now, if this is something that would interest you, or you're just curious and you want to know more information, simply click the link below, and I made a quick 3-minute video for you and posted it on my Patreon page that explains in depth not only the benefits of becoming a Patreon member, but also what our community is all about and what we want to accomplish with this platform. So I can't wait to work with you one-on-one, and I can't wait to grow this community to become one of the most impactful communities ever. And with that being said, I'll see you on the other side. Thank you. Now next, we're going to be talking about the importance of your mindset when it comes to investing, and specifically one principle that has literally changed my life as a whole for the better in almost every facet imaginable, because not only will implementing this principle have a tremendous positive impact on your investments, but more importantly, it will drastically improve the quality of your life, your happiness, and your health. And it all stems from the Pareto principle, which is commonly referred to as the 80-20 rule. Now, you've all likely heard of this principle before in one form or another, but in its simplest form, the Pareto principle simply states that for many of the events that occur in our lives, 80% of the results that we actually want come from just 20% of the actions that we take. So then if this is true, we should put the majority of our focus on just those 20% of things that yield us the biggest results that we want in our life. But what truly makes this so special is that you can literally apply the same principle to various aspects of your life. Like, what are the 20% of your possessions that you get the most value out of? What do you spend 20% of your time doing, but that brings you 80% of your happiness? Or even just figuring out what are those 20% of tasks that will yield 80% of the results that you want. You need to define what those are, and so that you can focus on them and prioritize them. So I encourage you to set some time aside and ask yourself these questions, because this one simple exercise can completely change your perspective on how you want to live your life and how you utilize your time. Now, in terms of investing, I actually applied this same principle to a very large extent to my investments, and it has enabled me to consistently beat the market. In fact, last year, my average annual return came in at well over 300+% compared to the market average, which is a measly 10%. So now let's go over how returns like that are even possible and how you can implement the same strategy for yourself. So this is how it works. If you've been investing for any amount of time now, you've likely noticed one particular trend, that your biggest gains tend to come from just 20% of your stock picks. And so knowing this is the case, then in order for you to truly capitalize on this, you need to make damn sure that you invested the majority of your portfolio into just those 20% of companies that you have the highest level of conviction in, and that are ideally also category disrupting companies. Because then even if the market does end up crashing for a prolonged period of time, as Cathie Wood, who is one of the greatest investors of our generation, often says, innovation is only accelerated during times of crisis. And now I know that many of these other stock market for beginner videos will teach you that you must have an extremely well diversified portfolio with 50+ different companies in it in order to mitigate your risk. And honestly, that strategy works perfectly, especially if you want to make absolutely no money whatsoever. Got it! No, but seriously, here's the thing. First of all, it's almost physically impossible for just one person alone, especially a beginner, to truly know and understand 20+ different companies inside out. let alone trying to stay up to date with all the news and current events of all these companies week in and week out. But putting that fact aside, even more importantly, as the legendary Warren Buffett famously said, diversification may preserve wealth, but concentration builds wealth. And concentrating your investments is without a doubt one of the most important and necessary factors to truly building a high growth portfolio. Now, what's the alternative? Well, you could have a super diversified portfolio with 30 plus different companies, in which case you would be lucky to even make 10% returns annually, because even if a handful of your stock picks really do end up taking off, the reality of the matter is that you won't even benefit that much from it, because you've spread your money so thin that even if several of your investments do incredible, it would barely be enough to really move the needle. So my advice and how I personally structure my portfolio is that I invest over 70% of my money into just 2 to 3 companies max, and then the other 30% I'm free to invest into more speculative positions without a worry in the world, because I know that the majority of my money is invested into companies that I have the strongest conviction in and that I have put the most hours researching. So I have no doubt in my body that these companies will take my portfolio to the promised land. Now, what we're going to talk about next is literally going to save you from making countless extremely costly investing decisions, and it will also help you stay calm while everybody else is panicking, because if you plan on investing your money into the stock market for any decent amount of time, well then crashes, corrections, and bear markets are inevitable.
I am inevitable.
But today I'm going to arm you with all the weapons you'll need to never fear these market events ever again. And in fact, after today, you will look forward to them as golden opportunities to create generational type wealth for you and your family. So first, let's define what these terms actually mean. So a market correction is any time that the market drops at least 10%, but no more than 20%. Because if it drops more than 20%, then that's now considered a bear market. And lastly, a stock market crash is simply whenever we have a very sudden and sharp drop in stock prices, which was exactly what we saw happen last year, when the market dropped almost 40% in just a matter of a few weeks. Now, make no mistake about it, having your stock portfolio drop 10 to 20% in a matter of days can be absolutely gut-wrenching for anyone, let alone newer investors. And this is where the majority of people f up, because they will start to make emotionally driven decisions. Like they'll start panic selling out of all of their stocks, and many times taking huge losses in the process, in hopes of avoiding any more pain. And they assume that if they don't sell right now, they risk losing all of their money. But before you make that costly decision to sell, you need to know the cold hard statistics. So on average, there's been a market correction once every year, meaning that the market drops between 10 to 20% almost every single year. And that's been happening since the early 1900s. Also, the majority of corrections bring the market down less than just 14% and last only about 2 months. Plus, 80% of stock market corrections do not turn into bear markets, meaning that the market does not drop more than 20%. And the reason why it's so important that you know and ingrain these statistics into your brain is because that it proves that market corrections are literally just a routine part of owning stocks. And so if you know that something like this is going to happen almost every single year, then why in the world would you panic every time it happens? That makes absolutely no sense whatsoever. Yet unfortunately, that is what most people do. Because as with anything in life, if you don't educate yourself and acquire a sufficient amount of knowledge on a particular subject, you will always be at the mercy of what other people want you to think, and thus remain in a constant state of uncertainty, especially when news outlets are constantly trying to mislead you by publishing articles with scary headlines in order to induce fear, because they know that fear gets clicks, and clicks brings in more advertisers. So I don't want any of you guys falling for that crap, and that's why I always want to empower you with the facts and the data, because at the end of the day, men lie, women lie, but numbers don't lie. And the numbers prove unequivocally that what you should be doing and what savvy investors do is that they start to get excited during market crashes, because they know that they can now load up on some of the best stocks while they are on sale. Because the reality of the matter is that market crashes are one of the greatest opportunities that you'll ever experience in your lifetime, that can literally catapult you from where you are today to where you want to be, much faster than most people can even imagine. And I am a living testament to this, because what most people don't know is that at the start of 2020, before the market crashed, I only had about $200,000 invested into the stock market in total. Yet by the end of the year, my portfolio had grown drastically and was already close to reaching that coveted $2 million milestone. So never forget, oftentimes in life, the best opportunities are disguised as problems, and it's the very same reason why there were more millionaires made during the Great Depression than in any other time in history. And so now you naturally may be wondering, what about trying to time the market? Wouldn't it be smarter to just wait for the next market crash and then pounce on the opportunity? And the answer to that is no. And here's why. So on average, the stock market goes up about 10% each year. But now here's some data that will absolutely blow your mind. So a few years ago, both Charles Schwab and JP Morgan did a 20-year long study where they found that if you were out of the market for just 10 of the best trading days in 20 years, so if you just missed 10 days in 20 whole years, then your gains were literally cut in half from 10% to just 5%. And if you missed 20 of the best trading days, well then you might as well not even have been investing because you only made a whopping 3% return. Which is exactly why you'll always constantly hear me preaching, if you watch my videos, that time in the market beats trying to time the market every single time without fail. And so the best strategy to implement for buying stocks is simply to dollar cost average in, which just means that instead of putting all your money in at once, you split up your purchases between several weeks or several months depending on your personal preference, so that over time your average cost per share is significantly lower than if you had tried to time it. And so now that you are armed with the most powerful weapon in the world, which is knowledge, let's go over exactly how you can prepare yourself for any and all potential market crashes that may come your way, and how you can always stay on top. So first, you should only invest money that you do not need to use within the next 3 to 6 months. Doing this puts you in a position of power so that you are not panicking if stocks have a temporary correction, because it's not like you need that money to pay this month's rent. Second, you should always aim to keep between 10 to 30% of your capital in cash, so that when great companies do go on sale, you will be ready and excited to pounce on the opportunity. It blows my mind that people literally will run away from great stocks that they were happily paying $100 for just last month, but now that it's on sale for $50, they all of a sudden don't want to touch it. Yet during Black Friday, when all these massive stores put your favorite products on sale, you're all rushing in to buy them, right? So you need to start looking at these market events from a position of power and understanding instead of fear, which mostly stems from the lack of knowledge. So if you truly want to succeed in life, first educate yourself, so that you can then empower yourself and then go and empower the people around you. Because remember, you are the average of the 5 people that you spend the most time with. So when your family and friends win, you win. Now earlier in the video, we discussed in depth exactly how you can go about consistently finding winning stocks that can bring you 5, 10, or even 100x returns. But now let's dive even deeper into more of the technical side of things. Because in order to achieve these high level of returns, there's no way in hell that you can do that while investing in what are called value stocks, which are companies that people believe are trading at relatively cheap valuations. And they usually come to this conclusion based on using a bunch of old school financial ratios to determine if a company is undervalued or not. And that's what the majority of these stock market for beginner videos will teach you how to do. But I'm not going to waste any of your time going over those outdated ratios, because my goal is to teach you how you can actually make real money by investing in the stock market. And so I'm not interested in teaching you guys how to be broke. No, but seriously, if you're investing in value stocks nowadays, the odds of making significantly more than 10% annual returns are extremely slim. And don't get me wrong, 10% returns are definitely far better than 0. But if that's your goal, then why would you even bother spending the time picking individual stocks at all? Because instead you could just simply invest your money into an index that tracks the S&P 500, which historically returns close to 10% annual returns without you pretty much having to do any work at all. And for those that don't know, when you put your money into an index fund, it basically allows you to invest into a basket full of stocks. And the S&P 500 is one of the most popular indexes because it specifically tracks and mimics the performance of 500 of the largest US publicly traded companies. And so overall, investing in index funds is not a bad option, especially for people who don't have much time or just don't want to spend the time doing research on individual stocks, but who still want to make some decent sized returns from the stock market. But over here on this channel, we're not about that 10% annual returns life. We want more out of our investments because we work way too damn hard for our money to only be making us 10% annual returns. And I don't know about you, but where I come from, if you're living under my roof, everyone has to put in their fair share of work. I don't care what color you are, how old you are, I don't even care if you're an inanimate object. Don't matter. You got to put in that work, and 10% just doesn't cut it around here. Now last year, my annual returns from my investments were well over 300%, which is just absolutely insane and not normal returns at all. And the odds of being able to pull off numbers like that consistently year after year are extremely slim. But that's okay because personally, my goal over the long run is to average at least 30% annual returns. And you may think that doesn't sound like a lot, but let me show you something. So this calculator over here really shows you the power of compounding returns. And if you weren't excited to start investing in the stock market before, this will really open your eyes to what's possible, as long as you're willing to put in the work. So let's say that over the years, you've been able to save up $10,000 and you decide to put that in as your initial investment into the stock market. And then every month going forward, you promise yourself that you're going to deposit just $500 extra into the market every first of the month. Now what happens next if you're able to achieve an annual rate of return of 30% is quite magical, because in just 10 years your investment, which started with just $10,000, is now worth almost $400,000, and in 20 years you are now looking at a whopping $5.6 million. And again, that's just in 20 years. And remember, all of this started with only $10,000 invested and just adding an extra $500 each month. So now just imagine the kind of numbers that would be possible if you were able to put in more than just $500 a month. And that right there is the magic of compounding returns and what's possible when you really put your money to work. Now obviously some years we're going to have bear markets and it's not going to be as easy to pull off 30% plus returns. But that's the beautiful part. You don't have to pull off 30% plus returns every single year in order to average 30% annual returns over the long run. Because as you saw with my last year returns, some years are going to be much better than others, and those amazing years will help bring up your averages on the other years when your portfolio doesn't perform as great. So when you start to think about it like that, it's actually much more realistic to average 30% annual returns than most people think. So now how can we actually evaluate the financials of these category disrupting companies that are setting out to change their industries to figure out if they're a good investment for us or not? So I can tell you right now, if you are basing your investment decisions on old school financial ratios like the price to earnings ratio, you will be missing out on some of the greatest investment opportunities time and time again. I remember just last year when I was making videos telling everyone that would listen to me exactly why I was so confident that Shopify was still extremely undervalued when they were trading at less than $300 a share. And at the time, literally every other YouTuber was saying the opposite, that Shopify was extremely overvalued. And this was because they were trying to value a high growth company using financial metrics like the PE ratio, which just flat out doesn't work. And since I released that video explaining in depth exactly why I was buying Shopify stock, it has more than quadrupled in value and is now trading at well over $1,200 a share. So now here's what you need to know. There are two things in particular from a technical aspect that I always look for when evaluating a potential high growth company. One, they must be growing revenues by more than 20% annually, and management must be expecting for this trend to continue into the foreseeable future, meaning for at least the next 5 to 10 years. Two, their total addressable market, otherwise known as their TAM, must be substantial and in a growing sector, not one that is declining. Now, the easiest way to think about TAM is it's basically the total amount of demand that exists for a specific product or service. So for example, if you're doing research on a company like Tesla or even NIO, these are some of the type of questions that you undoubtedly need to be asking yourself and doing research on. Like, what are the total number of electric vehicles sold today in the US and in China? What about globally? Then based on your research and where you think the trends are heading, what could that number evolve into in 5 years from now? And what about 10 years from now? Also, it's no coincidence that if you look at my portfolio, a very large portion of it is invested into the EV sector. And this was done very intentionally. Because just think about it, right now electric vehicles make up less than 5% of global automotive sales. But by 2030, based on my research, I am more confident than ever that that number will be a lot closer to 100% than it is to 0%. So that's why these are two perfect examples of great companies who are in an extremely fast-growing sector and who are also going after massive total addressable markets, especially considering that automotive sales alone is a multi-trillion-dollar industry. And then when you combine that with the fact that Tesla, in particular, is looking to disrupt multiple trillion-dollar industries such as insurance, solar, and don't even get me started on robo-taxis, it becomes very clear that they check all of our boxes. And the best part is that you can easily find all of this information for the majority of publicly traded companies by doing a simple Google search for the company's investors relations page, and it'll usually be the very first result that pops up. And once you land on that page, I recommend first going through their investors presentation. Not all companies have this, but many do, and it's extremely helpful in understanding where the company is today, what are their ambitions, and exactly how they plan on reaching these goals. Afterwards, I also highly recommend listening to their latest conference call. Now, these are usually only about 30 to 60 minutes long, so not even that long, but they are absolutely value-packed, because it's where the company's management team has a chance to give their investors additional insights on how the current quarter is going and what to look forward to in the future, as well as oftentimes they even take questions from investors, i.e. us, directly. So yeah, you're not going to want to miss any of these calls, especially for any companies that you plan on investing in heavily. And last but not least, you'll also want to go through the company's 10K, which is their annual report, as well as their 10Q, which is their quarterly report. Now, the annual report is just incredible because it shows you the company's earnings for the past several years, as well as it gives you a tremendous amount of details on what they've accomplished so far, their current financial health, and it even outlines what their strategy is going forward. So once you've reached this point of your research, you should really have an extremely high-level understanding of the company inside and out. But if for whatever reason you're still struggling at this point and you still feel like you don't truly understand this company that well, even after putting in the hours to do the research, that's completely okay as well. And this does happen from time to time. And it usually just means that this company is not within your circle of competence, which is a term coined by Warren Buffett himself. And in essence, it simply means that everybody has different interests, expertise, and skills, and that you should use those to your advantage by investing in companies that you actually understand, because it will give you a massive edge over people who aren't as knowledgeable about that sector as you are. Also, it will save you from making one of the most costly mistakes that people make all the time, which is investing in companies that they barely understand and have no idea how they even generate revenue. And doing this makes no sense whatsoever, especially considering that there are literally thousands of publicly traded companies that you can invest in. So why would you ever invest in something that you don't truly understand? Now, also one very important thing to keep in mind is that when you're going through their investors relations page, is that all the information found there, such as what is their total addressable market and how much they believe that they will grow revenues by over the next several years, is provided by the company themselves. So obviously they are biased. So that's why you should always make sure to do your own independent research as well and use other sources to check if the information that this company is providing you actually checks out, and more importantly, that it makes sense to you. And once you got a rough estimate of what you believe this company's total addressable market will be looking like in 5 to 10 years, then you can really start figuring out, well, okay, what percentage of the total market do I actually feel like this company could get for themselves? Because they always usually have some sort of competition, right? So it's unlikely that they'll get 100% of the market share. But then the question becomes, do you think that they can get 20, 30, or maybe even 50% or more of that pie? And if that pie is big enough, then that can lead to absolutely exponential growth. And that's the key. Because at the end of the day, that's what truly matters when you're trying to value a high growth company. It's all about the kind of numbers that they could be doing several years down the road. It's not about the numbers that they're doing today. And that's why most Wall Street analysts fail time and time again to identify these once-in-a-generational type companies because they're too focused on playing the short-term game, whereas I'm laser focused on what's possible for this company to achieve 5 to 10 years down the road. Now, the more you implement these steps, the better you'll become at identifying these high growth companies early on. And so then this next section starts to become even more important, because if you plan on making any significant amount of money in the stock market, well, guess what? The tax man is gonna want his cut.
Oh no! Oh no!
Oh no!
Oh yeah!
And so if you want to keep more of your money to yourself rather than having to give it to the government, then make sure to pay close attention to this section, because not only are we going to cover exactly how taxes work for stocks, but also we're going to be going over several tax strategies that you can easily implement that can save you from having to pay any taxes at all on your gains, or at least greatly minimize your tax burden as much as possible. So the first thing that you need to understand is that if you were to buy a stock for $100 and then sell it for $110, that means you now have a $10 profit, or in other words, you have a capital gain. And a capital gain occurs whenever you sell an asset, such as a stock, for more than you paid for it. But if the opposite scenario were to play out and you end up only being able to sell that stock for $90, then that means you now have a $10 capital loss because you sold your stock for less than you originally paid for it. Now, obviously, nobody enjoys taking an L, but the good news is that come tax time, you are allowed to offset your losses against any gains that you might have. So basically, your losses can help minimize the total amount of taxes that you have to pay at the end of the year. Also, there are two different types of capital gains. There's short-term and then there's long-term capital gains. Now, short-term just means that you held the stock for less than 1 year before selling it for a profit. And so that means you have to pay short-term capital gains tax, which is taxed at the same rate as your regular taxable income is taxed at. Whereas if you had held the stock for at least 1 year before selling it for a profit, you would only have to pay long-term capital gains tax, which is usually a far more favorable rate because you are no longer taxed at your regular tax rate. And instead, depending on your income, you only have to pay a fixed rate of either 0%, 15%, or 25%. And this is one of the many reasons why I love being a long-term investor, because it saves you a ton of money come tax time. Also, keep in mind that you don't have to pay a single penny in taxes until you actually realize your gains, or in other words, until you actually sell that stock. So for example, let's say you had bought some Tesla stock several years ago, and since then the price of Tesla has absolutely skyrocketed. So let's say that you now have a $100,000 gain on your position. Well, until you actually sell those shares, that $100,000 is called an unrealized gain, and you don't owe any taxes on that whatsoever until you actually decide to sell, which is incredibly powerful because as long as that company continues to execute at a high level, your money can keep compounding and growing completely tax-free. But now let's get into the really good stuff, because there's one step that you can take this week that is completely free and only takes about 5 minutes to set up, yet it could potentially save you from having to pay any taxes whatsoever on your gains from selling stock. And it's called a Roth IRA. Now, an IRA simply stands for an individual retirement account. But inside of this account, you can purchase and sell stocks just like you would on any regular brokerage account. By the way, a brokerage account is just a fancy word for an investment account that allows you to buy and sell stocks. And don't worry, a bit later in this video, I'll be showing you guys exactly which brokerages I personally recommend, as well as I'll be doing a live demonstration showing you exactly step by step how to buy and sell stocks the right way. But now what makes a Roth IRA so special and such a powerful tool is that you don't have to pay any taxes whatsoever whenever you sell stocks for a gain inside of your Roth IRA. And it doesn't even matter how long you held the stock for.
Oh my God! Wow!
So whether you just held the stock for a couple of months or even a few days, doesn't matter. Still no taxes need to be paid on your gains. Sounds too good to be true, right? But hold your horses, because there are a few restrictions that you need to know about. So first, generally speaking, you are only allowed to deposit up to $6,000 into your Roth IRA annually. And any money that you deposit into your account is called a contribution and can be withdrawn at any time without any penalties. But any earnings, aka gains, that you make inside of that Roth IRA should not be withdrawn until after you turn 59 and a half years old. Because if you withdraw your gains early, then you have to pay taxes on it. Plus you are hit with a 10% penalty. Now back in 2013, I didn't have much money, but I still decided to open up a Roth IRA anyways, and I managed to scrape up just enough of my savings to buy a total of 17 shares of Amazon for about $300 each, which came out to just about $5,000. Well, let's just say that those 17 shares are now worth close to $60,000, a more than 10x on my money in just a couple of years, and I still to this day have not sold a single share. So just remember, you don't need a lot of money to make a lot of money. What matters most is that you get started. Also, since I bought those 17 shares inside of my Roth IRA, that means that when I retire and actually take that money out, I won't have to pay a single penny in taxes, no matter how much profit I end up making on that position over the next 30 plus years. So guys, do yourself a favor and open up a Roth IRA this week, because it can literally end up saving you a small fortune in taxes. And that applies even if you don't have a lot of money right now, because as you saw, you never know what your investments can grow into, no matter how small they start. Now let's go over which brokerages you should trust with your hard-earned money, because there are literally hundreds of different brokerages out there, but I personally only recommend 3. And for all 3, it's completely free to sign up, and they do not charge you anything to buy or sell stock, which is incredible, because back when I first started investing, I actually had to pay $10 every single time I decided to buy or sell any stock. But nowadays, almost every brokerage allows you to trade for free. So for me, which brokerage you should go with really depends on what level you are right now. Because if you're just starting out and you only have a few $100s to invest, or basically for anyone investing with less than about $2,000, I would personally recommend using Cash App, because they are one of the few platforms that allow you to buy fractional shares, which means that you don't have to buy an entire share of a stock. And this is extremely convenient, especially if you don't have much funds, because right now, for example, to buy one whole share of Tesla would cost you about $850, which not everyone can afford. But with Cash App, even if you just have $100 or $50, you can still buy a percentage of Tesla stock, which is awesome. Plus, if you use my link to sign up, they also give you $5 for free, just for setting up your account. Now let's say you have $5,000 or more. In that case, I would highly recommend using either TD Ameritrade or Webull, or even both, as they both offer much more advanced tools and have incredible customer support. Now for me personally, I use TD Ameritrade for the majority of my investments, and it's also where I opened my Roth IRA. But I also use Webull for some of my smaller positions. And actually, if you use my link, which will be in the description box below, they will give you 2 completely free stocks valued up to $1,600 just for signing up and depositing $100 into your account. And I don't know about you, but I've always loved me some free money. So if you don't already have a Webull account, I highly recommend taking advantage of this offer. Also, before we get into our live demo where I'll be showing you exactly how to buy our first stock, I want to clear up one of the biggest mistakes that I see so many investors make, especially beginners. So let's take a look at 2 very well-known stocks in Apple and Chipotle. Now, many young investors fall for the trap of paying way too much attention to a stock's price. So they immediately assume things like Apple stock must have a much higher chance of doubling, since it sounds much easier for them to reach $275 than it sounds for Chipotle to reach $3,000. But that couldn't be further from the truth. And in fact, a stock's price is actually pretty irrelevant, because what truly matters is the company's market cap. Because remember, a stock's price is simply calculated by taking the company's market cap and dividing it by the total number of shares outstanding. And so the real reason that Apple stock price looks so much cheaper than Chipotle is because they have so many more total shares outstanding. Or in other words, Apple decided to cut their pie into a multitude of very small slices so that they can charge less per slice. Whereas Chipotle decided to cut their pie in a way that gives much bigger portions to each investor, but thus there are less total slices available. But at the end of the day, the reality of the matter is that in order for Apple stock to actually double, their market cap would have to grow by more than $2.3 trillion, which, let's just say, that is no easy task. In fact, there are only about 5 companies in total in the world that have even reached a valuation of more than $1 trillion, whereas Chipotle, on the other hand, would only need to grow by $42 billion in order to double their current stock price. So don't get fooled by just looking at a stock's price, because that number doesn't really matter much at all, and it's much more of a vanity metric than anything else. And the decision of how a company decides to cut their slices is really up to management. But what you need to know is that whether they decide to cut their slices into smaller or bigger portions, it makes absolutely no real material difference on the fundamentals of the company. The only thing that it really impacts is the stock's price. And now the reason that some companies like Apple do decide to issue more total shares is in order to make their stock more accessible and affordable to everyday investors like you or me. So I hope that clears up a ton of confusion for you guys. But now without any further ado, let's get into the grand finale. Now for the final part of this video, I'll be doing a live demonstration showing you exactly how to buy and sell stocks the right way, step by step, as well as covering some of the more intricate details that even people who have been investing for years might have never known about or even realized. So let's get right into it. So this is my TD Ameritrade account. Now, as I mentioned earlier, I do use multiple different brokerages. So these are not all of my positions, but TD is by far and away where I have the majority of my investments. And it's also the brokerage that I recommend the most. Plus they have some really cool features and resources that we'll be going over as well. So when you first log in, you'll immediately be able to see all of your different accounts, as well as it'll show you some of your biggest positions inside of those individual accounts. Now today there really wasn't much movement for my portfolio. It's only up about 0.5%. But as you can see, they make it super easy to switch between your accounts, as well as create a new account if you want. That way, if you want to create multiple different portfolios to separate them by different categories or even different goals, you can do so easily by clicking right here. And it takes less than a minute to set up a new account, which is pretty cool because many other brokerages limit you to only having one account, whereas with TD, you can open up as many as you want. So the way I set mine up personally is I have my main portfolio listed under stocks, and then I also have a traditional and a Roth IRA set up as well. And then I have two special Patreon exclusive challenge portfolios. The 10K to 100K challenge is the one that I mentioned earlier in this video, and we are already up well over $3,000 on those positions. And then we also have a 5K to 100K challenge where we're only doing options trading, and we are already close to doubling that entire portfolio in just about 2 months, which is just absolutely incredible. And all of our Patreon members get access to both of our challenge portfolios. That way they get to decide whether they want to participate in both of our challenges or just one. And I always instantly notify them before I make any moves, whether that be to buy or sell any stock or options contracts. So yeah, if you're interested in joining the family, it'll be the first link in the description box below. But with that being said, let's get back to our demo. So if you scroll down just a bit more, you'll be able to see a market snapshot of how the markets as a whole performed today, which is pretty useful. But now one of the resources that I absolutely love that TD offers and that many people don't even notice is if you scroll down just a bit more and click on their calendar. This thing is just loaded with valuable insights. And the section that I personally look at the most is the earnings tab, because it will show you on the calendar exactly when every single publicly traded company reports their earnings. And more importantly, you can sort it so it only shows you the dates of companies that you actually invest in, which is extremely convenient because remember guys, when a company you invest in reports earnings, depending on what they report, the stock could go absolutely skyrocketing or plummeting. So you always want to be aware of these dates, especially for companies that you have a large position in. But now for the moment of truth, because it's time to actually buy our first stock together. So in order to do that, all we have to do is scroll all the way back up, click trade, and then select stocks. At which point you'll be taken to this page. And now let's just say you wanted to buy a share of Apple, but you weren't sure what the stock symbol for Apple is. So now TD does provide a built-in symbol lookup tool, but honestly, it's just way easier for you to just go on Google and just type Apple stock, at which point Google will easily provide you with a ton of information about whatever stock you're interested in, such as that the ticker symbol is AAPL, and that it trades on the NASDAQ, which is one of the biggest stock exchanges in the world. Now in America, there are two major exchanges, the NASDAQ and the New York Stock Exchange. And an exchange is just a place where you can buy and sell stocks. Now it also shows you some extremely useful information, such as the market cap for Apple is currently sitting at around $2.2 trillion. And then above that, it shows you a live chart of exactly what happened today during the trading day, which is, by the way, is Monday through Friday from 9:30 a.m. to 4:30 p.m. Eastern Standard Time. So you can see that today Apple stock started the day at around $134. and then trended upwards for the rest of the day till it got to around $135. So nothing too crazy, but you can also zoom out and see exactly what their stock has done the past month, the past 6 months, and you can even go back 5 years plus, which really puts things in perspective. Because if you had just bought some Apple stock 5 years ago, it would have cost you less than 25 bucks. Meaning that if you had put $10,000 into Apple in 2016, you would already have more than $50,000. And that would be more than a 5x on your return. And don't even get me started on the possibilities if we look back 10 or even 20 years out. Because in the early 2000s, Apple was trading at less than $1 a share. So we're talking about more than 100x plus return in less than 20 years.
It's crazy out there. Some of these stocks, you should see them. Oh my God.
Alright, awesome. So now that we know the symbol for Apple stock is AAPL, we simply type that in, and then a mini version of the chart that we just saw on Google will pop up to the right. And now the market is currently closed as I'm recording this video. So on top it will show you the last price that Apple sold for before the market closed, which was $135.37. And remember, the stock market is just like any other marketplace. So there are both buyers and there are sellers as well. So you will always see a bid and an ask price. Now the bid is what potential buyers are currently willing to pay for 1 share of Apple. And then the ask price is what sellers are willing to sell 1 share of Apple stock for. Also, if you notice, the difference between the bid and the ask price is only about 7 cents. So when the markets open again, what will happen is they will come to an agreement somewhere in the middle on the price, just like what happens in any other regular marketplace. Now let's say that we wanted to buy just 1 share of Apple. So we would enter 1 here, and then we have 2 very important last options to configure. So when you have your order type set to market, that simply means that you are placing a market order. So you are telling your brokerage, hey, whatever price Apple is trading at tomorrow when the market opens, I want you to buy me 1 share. So whether the stock price opens at $135 or even $150, TD will buy you 1 share of Apple at the opening market price. Now, putting your order as a market order is usually perfectly fine to do when the market is actually open, because your order will pretty much get executed and filled instantly. So whatever price is showing here is what you'll get and you'll be good to go. But you do have to be just a bit more careful when the markets are closed, because for example, if you submitted this as a market order now, then your order would be filled at whatever price Apple stock opens at 9:30 a.m. Monday morning, which could be very different than the price that you're seeing now, especially if there's like some huge positive news in the morning that might cause the stock to go up an extra $10, $25, etc. And that might be a price that you weren't actually willing to pay. So if you want to protect yourself from a scenario like that ever happening, what you can do is, well, you could wait till the market actually opens and then just place a market order, or you can instead simply change the order type to a limit order. Now, if you notice, there are a couple of other options shown here, but those are more advanced, and honestly, 99% of people will never need to use any of these. So now when you select a limit order, it basically allows you to enter exactly what price you're willing to pay for Apple stock. Or in other words, what's the maximum price you're willing to pay for 1 share of Apple. So with a limit order, there's never a possibility of your order being filled at a higher price than what you're willing to pay. Because if the stock is trading at a higher price, then your order will simply not be filled and will instead be canceled at the end of the trading day. That is unless you change the time box. So when you click here, it does give you multiple options, but I personally don't recommend that beginners use the extended hours option, because that's what we call after hours trading, which takes place from 4 p.m. to 8 p.m. Eastern. And it's very similar to regular trading, but just that there's a whole lot less participants, meaning that there's less buyers and less sellers. Which means that, the stock prices can be very different during after hours than when the market actually opens. So unless you have a very specific reason for doing so, I don't recommend using it, but it is cool that TD does give you the option to do so if you wish. But now another thing that you can do is you can click good till canceled. And let's say, for example, you're only willing to pay $100 for Apple stock because that's what you think it's worth. So you can enter 100 here, and then you can select the date here up to 90 days in the future. Meaning that if Apple stock hits $100 or less before this date, then TD will buy you 1 share of Apple for $100. And so a limit order is a great way to potentially buy a stock when it dips without you having to constantly monitor it or check it at all, because TD will handle everything for you once you place that limit order. But just to keep our demo simple, we'll just place our order as a market order, and then we simply click review. Everything looks good. And as you can see, it's completely free to trade on TD. So now we can click submit. And now our order is officially submitted, and it will be filled, meaning that we will buy 1 share of Apple on Monday morning when the markets open. And since we placed our order as a market order, it'll execute at whatever price Apple opens at. Alright, awesome. So now that we've covered in depth exactly how you would go about buying a stock, let's now go over how you would then sell that stock, because there are some extremely important differences that you absolutely need to know. Now to start, the process is really simple and very similar to buying a stock. So we would simply change this to sell. Then we can enter again AAPL for Apple stock. And as you can see, I currently own over 750 shares of Apple. So let's say I wanted to sell just 1 share. I would enter 1 here. And now just like with buying a stock, for selling a stock, I can also put this order in as a market order, meaning that I am willing to sell my share of Apple at whatever the current market price is. Or in this case, since the market is currently closed, whatever the market price is when trading actually opens back up on Monday morning. Now let's say that we were only willing to sell our Apple stock for $140. So we would then select a limit order, enter 140 here, and we can either leave this as day, which means that when the market opens, if Apple stock price doesn't reach $140 by the end of trading day, then my order will be canceled. Or we can select good till canceled. And then we can set it so that our order stays open for at least the next 90 days. Meaning that if Apple stock reaches $140 at any time within the next 90 days, then our order will execute and that $140 will be added to our account. But in this case, we'll just keep it simple and leave it as day. Now here's one very important difference that you absolutely need to know. So as you can see, when selling a stock, TD Ameritrade gives you one more configurable option that didn't pop up before for buying a stock. And it's called the tax lot ID method. Now that might sound a little complicated, but it's really not. And selecting the right option here can actually help you save a ton of money in taxes. So right away, you'll see that there are 4 options. FIFO, which is first in, first out. LIFO, which is last in, first out. And then there's highest cost and lowest cost. Now the best way that I can explain this to you guys is by using my portfolio as an example. So as you can see, I currently have over 780 shares of Apple, which accounts to me having more than $100,000 invested into Apple stock. So let me ask you, do you guys think that I just bought all those shares at once? Like, one day I just woke up and decided, you know what, I like my iPhone a whole lot. I love those little blue bubbles when I send messages. And the emojis are pretty dope as well. Let me go ahead and buy 6 figures of Apple stock today. Of course not, and most people don't. Most people buy a couple shares of a company one day and then gradually continue adding to that position over time, over multiple months or maybe even years. And hopefully if you picked a great company to invest in, then the stock's price would also increase over that time span. Thus, your position in the company would keep getting bigger and bigger as you put in more money and as the company's stock price keeps appreciating in value. And then one day, next thing you know, you have over 6 or possibly even 7 figures invested into multiple companies and your portfolio is looking incredible. And that's what I want for each and every one of you, to reach those milestones at one point or another in your investing journey. But getting back to the main point of this story, since the majority of people by far buy a stock multiple times and not just once, this means that you are buying into the stock at multiple different prices and at different dates, which has huge tax implications. So let's say you bought 100 shares of Apple for $200 and then just a few weeks later, the stock dips to $150. But that doesn't faze you at all. So you buy 100 more shares, but then over the next couple of days, it continues to plummet all the way down to $100 a share. But your conviction is still sky high because you did your research and so you decide to buy another 100 shares like an absolute baller. Fast forward just 1 month later and it turns out that those huge balls of steel that you carry around everywhere have absolutely came through for you yet again, because you now have a total of 300 shares of Apple and the stock has skyrocketed all the way back up to $200 a share after Apple reported some incredible earnings. Well, now you decide that you want to lock in some of your profits and sell 100 out of your 300 shares. But the question now becomes, what are you going to get taxed on? Are you going to get taxed based on your average cost being $150 a share? No, you're not. And actually, you shouldn't want to be taxed like that, because there's a much better scenario here that you can take advantage of. You see, if you select FIFO, which stands for first in, first out, that means that they will take your cost basis from the first shares of Apple that you ever bought and use that to figure out your tax implications. Well, since you bought those shares at $200 and the stock is currently trading at $200, that means you have $0 in profit on that particular lot of 100 shares, and thus you don't have to pay any taxes whatsoever. Versus if you hadn't known what you were doing and so you just randomly selected LIFO by mistake, which stands for last in, first out, that now means that you would have to pay taxes based on a cost basis of $100 a share. And since the stock is trading at $200 a share currently, that means you now have to pay taxes on $10,000 in profit. Which is just no fun, but luckily for you, you are watching this video and you subscribed to the channel and turned on bell notifications, right? So you won't ever make mistakes like that, because you're part of the family and we got you.
You smart. You loyal.
But yeah, that's why understanding this stuff is so important, because based on what you end up selecting here, it could be the difference between paying $0 in taxes or thousands of dollars in taxes. So that's what FIFO and LIFO means. Now, highest and lowest cost, that's kind of self-explanatory, but also one other thing that you should know is another scenario that you might want to select FIFO is if you have some shares that you bought over a year ago and some that you just bought recently. So depending on the situation, oftentimes it makes more sense to sell the ones that you bought first, because then you would only have to pay long-term capital gains tax on those versus short-term capital gains tax. But anyways, for this example, I'll just simply click FIFO and then click submit. And just like that, we've now officially bought and sold our first stock together. Now this video literally took me more than 2 weeks to outline and record, so I really hope you guys got a tremendous amount of value from it. And if you did, please make sure to hit that like button and share this video with at least one friend or family member, or even post it on your social media. Because remember, you are the average of the 5 people that you spend the most time with. So when you help level up the people around you by sharing knowledge and value, then those very same people can later on help lift you up, and you guys can reach that next level together. Also, I love talking to you guys and I always try my very best to reply to as many comments as possible. So let me know your thoughts on my investing philosophy and let me know what stocks or topics you want me to talk about next in the comment section below. And remember, if you're interested in becoming a Patreon member and joining the private community, it'll be the first link in the description box. But remember to sign up quick, because signups will only be open for a few days and then it'll be closed for the rest of the month. But with that being said, especially if you made it to this point in the video, I have so much love for you. Thank you so much for watching, and I hope you all have an absolutely amazing rest of your day. Peace.